Good morning, everyone. I'm Brian Manning. I'm a financial advisor for Pinnacle Financial Partners here in what is snowy Nashville, Tennessee today. We're thankful to be able to spend a few minutes with you today. Typically the Pinnacle brand is built on distinctive service and effective advice. And historically, one of our favorite ways to deliver on that brand is to find a wonderful speaker like who we have today and get several of our friends and clients and community partners together in a place and maybe feed you lunch or serve you a cocktail and let you listen to somebody share some really insightful information with you and take that back to your business or personal life to apply. But in the middle of a global pandemic, getting large groups of people together is a bit frowned upon. And so we've had to come up with some new creative ways to try and provide you distinctive service and effective advice. And this Pinnacle Point webinar series is our new way of trying to do that. And so we're thankful for Ron Temple for giving a few minutes of his time to be with us today. Our webinar today is brought to you by the Pinnacle Trust and Investment Services area of Pinnacle Financial Partners. Keith Davis is the manager of that team, and Keith and I have been friends and business associates for many years, and they do a fantastic job of offering comprehensive trust services to their clients. And we're thankful that they embrace being effective advisors and putting together this webinar today and bringing us Ron Temple to share his thoughts on the economic outlook. Before I introduce Ron formally, I just wanted to go over just a few housekeeping items. Ron's going to go through a presentation for us this morning. And if you've got questions, then there is a question and answer function through the webinar. You can type in your question and we will do our very best to answer that question at the end. We do want this to be interactive. If there's something specific that Ron addresses during his presentation that you would like for him to talk more about, please let us know. And once he concludes his presentation, then we'll open it up for the Q&A and try to get your question answered. We've got everybody muted, so you don't have to worry about that. We'll just let Ron do his part in talking, and then we'll go through the Q&A at the end. Additionally, we will have this webinar recorded. It will be available shortly after the conclusion of the program today on our YouTube channel. So you can find that by going to youtube.com/watchpnfp. This webinar will be available just like all of our other webinars that are out there. So if you find this informative and you want to go back and watch it again, that's great, or share it with a friend, that's wonderful. So it will be available for you there. Now it's my pleasure to introduce our speaker today. Ronald Temple is the Managing Director and Co-Head of Multi-Asset and Head of U.S. Equity for Lazard Asset Management. He joined Lazard back in 2001 after 10 years of global experience, including fixed income derivative trading, risk management, corporate finance, and corporate strategy for companies literally across the world. His educational background is equally as impressive as a professional background because he holds an MPP from Harvard University, graduated magna cum laude with a BA in economics and public policy from Duke University, where he's still very involved. We may ask for his comments on the men's basketball program there a little bit later and see if he's got some insights on what exactly is going on there. It's been a rough year for them. But we're very thankful that Ron's given some time to be with us today and share his thoughts and insights on what's been an interesting start to the global economy here in 2021. So with that, Ron, I'm thankful that you're with us today, and I will turn it over to you, my friend.
Great. Thanks, Brian, for that introduction, minus the Duke basketball comment. So anyway, it has been a tough year. I'm going to refrain on that topic. So it's a pleasure to be with everyone today. And I have to say, it's a pleasure in particular because I haven't been this optimistic about the near-term economic outlook in a long, long time. I would say since well before the global financial crisis back in 08, 09. And the reason I say that is I do believe in the next 2 years, we might see the fastest economic growth in the last 50 years in the United States. I think the market is underappreciating how quickly the vaccine rollout is going to occur. Frankly, the kind of spoiler alert on the headline here, I think in the United States, we will have anyone who wants to have a vaccination will have it within, say, the middle of the second quarter, maybe at the latest, the end of May. And I'm going to go through those things. Now, a key premise of my key underpinning of my optimism is that vaccine rollout. But I think what's different about this recovery from the global financial crisis and most other recessions we've seen in my lifetime is that we've actually got a confluence of events of severely depressed consumption, consumers sitting on piles of cash, Even before the latest Biden proposal for COVID relief, US consumers had basically saved in excess $1.5 trillion in the last year. If you think about it, I mean, if your income actually has been untouched by this pandemic, but you haven't been able to travel, you haven't been able to go to restaurants, you've probably banked quite a bit of money from eating at home and not going away. I think that's true across this country of 330 million people. You add the Biden round of aid that's likely to come, you could be over $2 trillion of pent-up savings. Number two, you got fiscal stimulus beyond just the Biden package. We're going to have, if Biden's proposal passes, over $5.5 trillion of federal stimulus in a matter of about 24 months hitting the economy. That is over 25% of US GDP in a 2-year period. If you want to compare that to the financial crisis, the fiscal stimulus then was about 4 to 5% of GDP, and that took over 18 months to be used. So this is a completely different quantum from what we saw in 2008 and 9. And then last, and very importantly, for the first time in any of our lifetimes, at least since the 80s, we've got a Federal Reserve that has been very explicit that they are not going to tighten monetary policy until inflation is at 2% and on its way to exceeding 2% for a sustained period of time. 2018 was a big lesson for the Fed. They took the punch bowl away too early in hindsight. They basically had to end up cutting rates the next year because they realized it was a mistake, because they tried to get ahead of inflation when there was no inflation. Well, this time the Fed's not going to do anything until the inflation is here and evident. So I think you line those three things up, you could easily see US real GDP growth in 2021 at or above 6%, and again in 2022 at or above 6%. Now, again, when I look back in the last 50 years, we might have had a couple quarters at 6% real GDP. We haven't had 2 years. So I think this is a pretty exciting environment, but again, largely contingent on resolving the pandemic. So with that, I'm going to jump to the slides and talk you through kind of the narrative, how I think about this. And I'm focusing, by the way, on the US in these initial comments, because I think the US is the place where we should be most optimistic as a major engine of growth. I think Europe is going to see a very strong recovery, but we're not going to see 6% for 2 years in a row in Europe in terms of real GDP. Hopefully we can get a 4 handle on that number. And the big difference, the ECB is going to sit on its hands just like the Fed, but in Europe, the fiscal stimulus has been a fraction of the US. And so you don't have that extra fuel on the fire coming in Europe that you've had in the US from the federal government. And in China, I think we will see strong growth, but again, it will be more of the same, not unlike what we saw pre-pandemic. So I've listed here some key things to watch, but really the key thing globally is the vaccine rollout. And in the US, as that rollout occurs, I'm going to talk through what we should look for in terms of jobs, et cetera. But let's start with the pandemic. And I do know people are pretty much sick and tired of hearing about the pandemic, but the good news is I think we are on our way out of the depths of this pretty definitively. There is always a risk that new variants or mutations of the pandemic could derail some of my optimism. And so I want to put that out there really early here. So far, it does seem that the vaccines we have are less effective in dealing with moderate cases of COVID-19 from the South African variant and to a lesser degree, the UK variant. But what's really critical to focus on is the vaccines are still extremely effective at preventing hospitalization and death. So again, if we can change this pandemic from something where you worry about being in the ICU on a ventilator or even dying to something where you think you might have fever for 3 or 4 days and you just stay home from work, that is a complete game changer from an economic perspective. And what I'm betting on is that the pace of the rollout of the vaccine at this point is fast enough that in the race against mutation, we will win across the US and Europe. The bigger challenge is making sure we get that win to be global enough that new mutations don't arise out of emerging markets and work their way through the US and Europe and make us less immune or more susceptible to the pandemic. So what do you see on this chart? What I'm trying to show you here is basically just where infection rates are now globally. On the vertical axis, what you see is the most recent 2 weeks of infection data divided by the prior peak. Now you'll notice the y-axis, the vertical axis, does not go to 100%. That's because there is no major country in the world at this point at peak infection rates. Every country has seen a decline from the peak that's pretty substantial. And what you see on the horizontal axis, the x-axis, is the most recent 2 weeks in terms of how many cases per million people per day. Now, if you're trying to find the USA, look on the horizontal axis across to 300, goes straight up to around 40%. And what you're going to see, the US is down 60% in terms of the number of new cases from our prior peak, which occurred only about a month ago. France is down about 60%, Sweden's down about 55%. And if you go kind of up to the right, you'll see Spain is down 45% and is at around 400 cases per million people per day. I'm going to show you in a minute where we were, but just to give you a sense, at the worst, North Dakota was at 1,500 cases per million people per day. So we have slashed the infection rate post the holidays through kind of these restrictions on mobility, and very importantly, through the rollout of the vaccine. Now, this chart has the same horizontal axis, number of cases per million people per day. But on the vertical axis, we say, what are the most recent 2 weeks versus the prior 2 weeks? And what you can see is there are some countries where the number of cases are going up. And you can see above the line, Saudi Arabia is at the upper left, Greece is at the very top, Qatar. But when you look on the horizontal axis, these are still at very low levels of infection. Greece is at 100 cases per day per million people. The US is at 300, right? So Greece might be having an increase right now, but from a much, much lower level. If you look below the line, what you can see, by the way, in the gold dots is developed economies. The brown dots are emerging economies. There are a lot of major countries seeing declines on a week-on-week basis, and pretty sharp declines in some cases. As you can see at the very bottom right, Portugal down over 60% in the last 2 weeks versus the prior 2 weeks, but still at a level of over 400 cases per day per million people. Now, moving to the United States, this is the same format as the first chart. The vertical axis is the number of cases in the last 2 weeks compared to the prior peak. Horizontal axis, number of cases per day per million people. You can see it's just kind of odd. I never noticed until just now, by the way, coincidental that there's a nice little band up to the right, like a 90-degree angle. But effectively what you've got is at the worst end of the spectrum, New York, Texas, North Carolina, still running at over 400 cases per million people per day. So those are still pretty bad numbers. And to give you context there, by the way, March of 2020, when New York was in the epicenter of this crisis, we were at 450 cases per million people per day. So effectively, we have the same number of cases that we had back in March when there was a bit of panic, at least in the New York area. The big difference is the death rates have collapsed. We've got better treatments. We've learned about how to treat people. And it seems that these versions of the virus that are circulating, even though there's evidence they might be more virulent or deadly in some cases, we're fighting it better than we have in the past. And if you look down the way down toward the middle of the pack, you can see in California, the biggest US state, we're below 300 cases per million people per day, down 75% from the peak levels. Again, making progress pretty much across the country. So why am I so optimistic about getting everyone vaccinated? Well, literally, I have to update this chart, it seems, every week or two. What I've shown you here is the number of vaccines being produced. So the top row, 2020, these are definite numbers already happened. We got 35 million doses of Pfizer and Moderna vaccine by the end of last year. So that's enough to basically vaccinate 17.5 million people, because those each take 2 doses per vaccination. In the first quarter of this year, Pfizer, BioNTech, and Moderna have each committed to 100 million doses. So that gets another 100 million Americans vaccinated by the end of March. The second quarter, a week ago, 2 weeks ago, Pfizer and Moderna were both saying 100 million more doses by the end of June. Now they're both saying 100 million doses each by the end of May. So by the end of May, you'll be up to 217 million people we can vaccinate. Again, assuming we get the distribution right. I'll come to that in a minute. But on top of that, we're going to have 100 million doses from Johnson & Johnson in the second quarter, and that's a single dose vaccine. So by the end of June, if not the end of May, we'll have enough vaccines to basically cover 317 million Americans. Now, let's step back again as a reminder, 330 million Americans in the country, and we're not vaccinating anyone below the age of 16 at this point. So every adult in the country will have the option of getting a vaccine by the end of June, if not sooner. And by the way, below that, I've also included Pfizer is now planning to produce 2 billion doses of vaccine globally by the end of 2021. Moderna 600 million, and that's likely to increase. Johnson & Johnson 1 billion, again, that's 1 dose per vaccine. And Oxford AstraZeneca 3 billion doses by the end of this year. So that's 3.8 billion people you could vaccinate. Global population 7.8 billion people. you got half your population covered by the end of 2021. Now, to me, if we just step back, if there's reason for optimism, beyond the pandemic, beyond near-term economic growth, it's pretty incredible that less than a year ago, we had no idea how long it would take to get a vaccine. Prior to this pandemic, the fastest vaccine development in history was 4 years for the mumps, I believe it was in the 1950s or 60s. We actually did this and started deploying a vaccine in a matter of about 9 or 10 months. So if you want to get optimistic, by the way, I do think healthcare is an area where innovation is going to be a big story for the next decade. And this to me is case example number one of why you should actually be interested in that space. So what about distribution? Because I've talked about number of vaccines produced. What about getting those vaccines into our arms and moving forward? So far, 78% of the doses that have basically been delivered to state and local governments and pharmacies have actually been administered to patients. And so what I've got here, by the way, this is as of Tuesday of this week. I recommend if you want to track this, just Google Bloomberg Vaccine Tracker. It's a great source. Every day they update it. And what you can see is 40 million Americans have gotten one of the 2 doses they need. 15.6 million Americans have gotten the second dose, and 16 million doses have not been used yet. But if you looked at these data 2 weeks ago, that 78% usage would have been somewhere around 60%. So the ramp is actually pretty steep. We've now had several days where we vaccinated over 2 million people on a single day. And if you look over the last 7 days on the global basis, it's 6.2 million people per day. In the US, it's 1.67 million people per day. So again, this is something where we're ramping up quite rapidly. And I do think you're going to be above 2 million people per day on a sustained basis as we move into the second quarter when that J&J vaccine comes online. Now, one of the biggest risk factors, other than mutation and variants, is people not being willing to get the vaccine. The good news is on that front, we're seeing significant progress. Now, the Kaiser Family Foundation does a monthly survey. They did one in September, then it was December, and now they're doing it monthly thereafter. And what this chart shows you is kind of the survey opinions people have given of when they would get the vaccine. And you can see that as of January 2021, there were already about 5% of people who had already gotten a vaccine. But if you look to the far right, the bigger issue is you had about 20% of people who said they would not get a vaccine or they would only get it if they were required to for work. You had another 31% who said they were going to wait and see how it worked. The critical part of this, if we want this economy to escape the pandemic and if we want to get back to normal, there is no time for people to wait and see. Because waiting and seeing means you're exposing yourself to the new mutations and variants, you're exposing yourself to the old version of the virus, and you're exposing everyone who's around you, including your parents and grandparents, who are much more susceptible to death. So I think the number one priority, other than getting the doses basically produced and distributed, is going to be changing public opinion over the next few months. And I think what you're going to see is more and more businesses basically saying you're not welcome here if you're not vaccinated, because it's going to basically kill that business if people don't feel safe going to a restaurant or getting on an airplane. So I think this is going to be a key priority for public policy officials. I think hopefully Americans are going to see that this is something that is safe. And we can talk more about that in the end if you want Q&A. But I think we're going to make progress on this front. We've already made significant progress in the last few months. And I think the other key issue here, the more people know someone who's gotten vaccinated and they don't grow a third arm or leg, the more comfortable people are going to feel about getting vaccinated themselves. And by the way, I should note, people who have had side effects, it's usually pain in their arm or they might get fever. But again, these vaccines are working. And if you look at places like Israel, they've been incredibly effective at curtailing severe illness and death. So that's the vaccine. Let's move to the economy. Presuming this vaccine rollout goes as well as I think, that gets you to this kind of 50-year high kind of growth rate. But even if I'm too optimistic, we are basically entering a period where we're going to have very high growth rates. Now, in December, I would argue that the $900 billion stimulus package that passed between the election, to say during the lame duck session, was a good start. It was necessary, but it was insufficient. I think the good part of that package was it did cover extending unemployment benefits to March 14th, so another month from now, but that's not long enough. Not everyone's going to be back to work. Not every restaurant and bar is going to be reopened. So people are going to continue to need benefits, and I'll cover who those people are in a bit. But that was a good start, not enough. The other part that was a good start was the $600 per person stimulus payments. Now, we can discuss this in Q&A. I personally don't think we need to be giving people $2,000 a person. I think we should probably cut that off at a lower income level where people actually need the money, as opposed to people who actually have a job, haven't lost their income, and don't need a check. But bottom line is it's better to give more money and have it be spent than to not get it to the people who need it. So again, this was a good start. Small business grants was the most generous part of the $900 billion, and I do think that's critical. What you're going to see later on is 33% of all Americans work for companies with fewer than 100 employees. Keeping those small businesses alive, I think, is vital to the economy as we move through this pandemic and get to the other side. What was missing in this package was no state and local funding. Now, I know there's a lot of noise out there about how some states actually have had more revenue during the pandemic than before the pandemic. That is very state by state specific. If you have states that are more dependent on tourism, this has been anything but good. If you're in California and New York, where people have a lot of stocks, yeah, they've actually had a lot of capital gains revenue. But if you're in a lot of the southern states where people don't have as much equity holdings, or where there might be more tourism revenue, this has been pretty dreadful. So the state and local government aid, I do think, was a critical missing component and is a key part of the Biden proposal for the $1.9 trillion. So $370 billion of this is state and local governments and transportation agencies. Again, not all of it has to end up being used, but this is very vital to those states that were hit and local governments that were hit by the pandemic. One thing you should know about state and local government, they employ 20 million people in the United States out of a labor force of about 160 million people. If you're wondering what the hell do all these people do, well, 12 million of them are in education, right? So if you want the state and local schools reopened, it's really critical that this funding gets to those state and local school districts is a key part of it. Another big part of it is local hospitals, state-related hospitals, law enforcement, protective services like firefighters. So again, this is important money. Another big chunk of this package is direct stimulus payments. So taking that $600 per person to $2,000. If I were president, I wouldn't be spending this much, but I think it's better to spend too much than not enough in this case. And unemployment insurance basically is extended as late as September. But keep in mind, you only get this unemployment if you're actually unemployed, so that money might not get spent in the end. One last thing, $160 billion for vaccines and testing. Again, anything we can do to accelerate the rollout of the vaccine and getting the economy fully reopened is money well spent, in my view. So you get all of that put together, that's a wall of money basically kind of hitting this economy right as we reopen, while some parts of the household sector are already sitting on a lot of cash. What else should we expect from government in the next year? I think that's going to be the most important thing you're going to get, is the COVID relief. I do hope that we actually see a multi-trillion-dollar infrastructure program. And I just want to step back for a second. All of my comments about stimulus and infrastructure here are not based on some personal philosophical view. These are based on my views of what I think will make the economy grow the fastest now and in the long term. We should definitely discuss in Q&A deficits, because this is an important consideration. But the single highest priority I could say for the government to spend money in the next 5 to 10 years is on infrastructure. Now, you don't have to travel very much across the US to see we have lousy infrastructure in many parts of this country. If you've left the country, by the way, and you go to Japan and you take the bullet train from Tokyo to Osaka, those trains were built 56 years ago. They've never had a single accident, and they travel twice to 3 times the speed of the fastest train in the United States. We basically have 80 to 100-year-old tunnels entering New York City that were meant to last 50 years. And if you look at the American Society of Civil Engineers, they basically rate our infrastructure at a D or a D minus and think we need to spend at least $3.5 trillion to basically get up to par, not even close to being world class. So if I could think of one thing that would raise productivity growth across this country, and keep in mind, when you raise productivity growth, you raise economic growth, you raise incomes, you raise tax revenue, it would be infrastructure. And over the last 50 years, this was always a bipartisan target. Remember, Trump campaigned on $1 trillion infrastructure program. It's probably the one thing Biden and Trump campaigned on that was the same idea. They both say they want a lot of infrastructure. So my hope is we will see some kind of bipartisan infrastructure program after COVID relief. And I think that's about all you're going to get on the legislative front until the 2022 elections. So I would argue, by the way, it's an interesting scenario here where the light blue wave might end up being the most market-friendly outcome we could have had. Now, that's a bit of a provocative, controversial view. But the reason I say that is it's the outcome where you get substantial COVID relief, which stimulates near-term growth. If you can get substantial infrastructure investment that raises long-term productivity growth, That's also market positive. But I'm actually betting that the Democrats don't have enough votes to get major tax increases through. I do think they might get through a tax increase on corporate income. Perhaps it goes from 21 to 28%, which would put us right in line with the average of the OECD. It's definitely not going back to 35%. And I don't think you're going to get any broad-based tax increases for middle-class consumers or even most of the upper-income consumers. On the margin, could there be tax increases for households that earn over $1 million a year? Yes. But I would just point out that's 0.3% of the US population that makes over $1 million a year. So from an economic perspective, whether it hurts you or me personally, is probably less consequential for the economy. What's more important to the economy is that broad base of consumption is alive and well, and there's extra stimulus. So what about the US economy? Get out of the politics. What about what's happening in the real economy? Well, here I show you the unemployment rate. Things look pretty good if you just look at the headline unemployment rate. We're at 6.5%. Prior to the last 5-6 years, that would have been deemed a very good level. But let's not forget we were at 3.5% the month before the pandemic hit. So still quite a lot of room. And more importantly, that unemployment rate, in my view, understates the true unemployment. What this chart shows you is the change in the size of the US labor force over the last year. And what you can see is we had a massive decline in the number of people who were considered part of the labor force in March of last year. Now, what does it mean to be part of the labor force? The Bureau of Labor Statistics considers you to be part of the labor force if you either worked or actively sought work in the prior 4 weeks. Now, during the pandemic, we had a period of time where people weren't allowed to go out and look for work. And in many cases, they might not have been able to check yes to say they were looking. So they became no longer part of the labor force, which means they don't count as unemployed and they don't count as part of the labor force. In total, over the last year, 4 million Americans have left the labor force, according to this Labor Department definition. Now, part of that might have initially been the pandemic, but part of it now might be parents having to stay home with their kids because they can't send them to school. If you add that 4 million to the unemployment rate and you add it to the denominator, the number of people in the labor force, the true unemployment rate is around 10%, which is the number Jay Powell has been quoting in his hearings most recently because he's taking the same approach to measuring unemployment. So the key point of those two slides is the numbers on the headline look good, but the real situation is still very, very bad. Keep in mind, in the global financial crisis, the unemployment rate never got above 11%. So we're still in a bad spot. But who lost their jobs? That's what's really interesting in this crisis. Is the job hit has been most severe for people at the lowest income levels, the people who work in restaurants, bars, movie theaters, cleaning hotel rooms. What you see on this chart is we showed you employment for low, middle, and high income people. So low income being people who make under $27,000 a year. The number of jobs in that category are down 22% from where they were in January of last year. Middle income jobs, say $27,000 to $60,000, down 5%. People earning over $60,000, the number of jobs are up 2%. Those are the jobs people like I do, where we work at home. No issue. If anything, I've saved money not commuting and paying for dry cleaning other than my jacket for this presentation. So effectively, if you think about it, this is why I said earlier, I'm not a big fan of handing out $2,000 to every household that makes under $150,000, is most of those households don't need it. Where they really need it is the people making under $40,000 or $50,000. But unfortunately, a little bit of waste is probably better than not getting the money to the people who do need it. I mentioned earlier, small businesses are critical to the US economy. What you see here is on the line across the top is the cumulative number of people who work for firms under a certain size. So 17% of Americans work for companies with fewer than 20 employees. 33% work for companies with fewer than 100. 47% work for companies with fewer than 500 employees. So the Paycheck Protection Program last year and the more recent expansions of that program are really important to keeping those job providers functioning, to keeping these companies alive and well so they can recall their workers when they're able to fully reopen and get people back to normal and sustain consumption and investment. And here you can see, by the way, small business revenue has basically been hit really hard with a decline of over 30% since the pre-pandemic levels. And again, that's part of why there's so much assistance needed in that sector versus large corporates who've actually had a lot more flexibility with global customer bases. Now, in the US, if it's not clear, what I'm going to be watching is the COVID relief and job recovery and small business survival rates and even small business creation rates. In Europe, what we're seeing is a similar story, but minus the fiscal stimulus, and also minus a key characteristic of the labor market I'll touch on in a moment. What we saw in Europe, by the way, is we've seen a pretty sharp recovery in the manufacturing economy. What the gold line here shows you is US. The black line shows you the Eurozone. Both cases, the manufacturing economy came back fast, in part because if you think about manufacturing, it's easier to do social distancing in a manufacturing setup. The service economy is a different story. In the US, we had a sharp rebound in services, not as sharp as in manufacturing, but it's been sustained because we've been able to have these kind of rolling mobility restrictions around the country, but we haven't had as severe restrictions as Europe. And Europe in the black line, they've actually turned well back below 50. And again, 50 is the demarcation between expansion and contraction. So Europe is back in a service recession. The US is still growing. So this is a challenge for the Eurozone economy. As it relates to monetary policy in Europe, the European Central Bank is going to continue to pump money into this economy, in part because they have a single mandate. The US Fed has two mandates. The Fed mandate is maximum employment and price stability. For the ECB, it's a 2% or below inflation target with no reference to employment. But what's important to know, headline inflation shown in black in the European Eurozone is at negative 0.4%, so the ECB is going to continue to be a source of funding. Now, I did mention European economies are benefiting from some fiscal stimulus, but not as much as the US. I do think this is very important. It makes me more optimistic on Europe than I have been in about 15 years. Is for the first time in this pandemic, the Eurozone has agreed to issue jointly backed, mutually backed debt to the tune of 750 billion euros to fund a European Union recovery fund. Now, again, this is a case where Germany is alongside Greece, alongside Italy, and they're all jointly guaranteeing this debt. The money will be spent completely independently of the size of GDP or the number of people. So this funding effectively will be channeled to the countries that were hit hardest by the pandemic and will be much more like a United States of Europe than we've seen before. Now, that 750 billion euros is on top of a 6-year budget of €1 trillion, but the 750 will be spent in 2.5 years as opposed to the €1 trillion budget being spent in 6 years. This is a major lift for growth, just not nearly as big as what we're seeing in the United States. In China, what are we seeing? Well, in China, they were obviously first in, first out. They had much more severe restrictions on mobility. They were able to exit the pandemic faster than the US and Europe. They did things, frankly, I think none of us would want allowed done. For example, you couldn't leave your home, much less travel between cities. But what the Chinese government did do to basically help the economy rebound once they exited the pandemic is they turned on the credit spigot. And what you see in the blue line here is basically a metric of credit growth in China. We call it total social financing. You can see that growth went from about 10% early in 2020 to 18% credit growth in the last few months as the government pushed more and more credit into infrastructure spending and into other investments to prop up the economy. And by the way, I think we often begrudge China's high growth rates, but I think sometimes you can learn by watching. China has increased its economic growth rate by a significant amount in the last 40 years by investing in infrastructure. There's no reason the United States and Europe shouldn't learn from that example and do something very similar with a focus on productivity increasing infrastructure. Now, one side effect that's a negative that China is going to be dealing with from that increase in credit is their debt divided by GDP has gone up a lot in the last 9 months. Sorry, this is as of the second quarter of 2020. You can see they were at 280% debt divided by national income, up 23 percentage points from the end of 2019. That basically reflects an economy that didn't grow, but where debt went up a lot. The black part of the bar is worth noting. That is non-financial corporate debt, which is almost back to an all-time high. In 2016, that was my biggest worry about China, was corporates were taking on more and more debt, irrespective of their profitability, just to keep people employed, to keep social stability. In 2020, that became the story again, and the Chinese authorities for the next several years are going to be working to reduce the amount of debt in the system, partly by growing the economy into the debt, but also by discouraging accumulation of debt. So if I step back, and I know I gave short shift to China and short shift to Europe, the US strongest growth in 50 years, likely to see 6% real GDP this year and next, assuming the pandemic progress works as I expect. Eurozone, I think you could easily see 4 to 5% real GDP this year, maybe 2 to 3 next year, much stronger than is usual for Europe, but not even close to the US. And in China, I think in 2021, you're likely to see real GDP that could exceed 8 or 9%, as the rebound from the pandemic lifts consumption. But in 2022, I think in China, you're likely to be back to below 6% real GDP as the economy subsides to a more sustainable level. What does this all mean for investing? Well, one of the most popular topics, I would say, in the last 3 months, it seems since the election in particular, there's been an elevated, maybe even fevered pitch of concern around inflation. I like to show this chart. This is the last 10 years of CPI and PPI inflation. The producer price index, much more volatile than the consumer price index, which is shown in blue. Consumer prices in the US haven't gone up more than 1% in over a decade. If I stretch this chart back to the 1980s, the last time the United States had sustained personal consumption expenditure inflation at 3% or higher was 1994. So you have to go back 26 years to find a time when inflation was sustained at 3%. Now, the reason I highlighted 3% is I don't think any of us should basically wake up with a rash because we have a 2.2% inflation rate, or even a 2.4. When you start getting to 3, 3.5, 4, that becomes a different story. My concern over inflation is very low at this point. Why? It takes years for companies and employees to actually get the confidence that they can actually demand higher wages for the employee and higher prices on a sustained basis for the company to be confident that they can start passing through systemic cost increases. Now, I do think over the next 12 to 24 months, inflation expectations are going to go up. And we're already seeing that come through in the fixed income market. The reason I'm starting with this is I think the expectations will go up, but I'm not confident that actual inflation will go to say 2.5%, 3% and stay there. I do think you will see inflation hit 2 to 2.5% for a few months as some of the base effects, meaning year-over-year change in gasoline prices, for example, starts showing up in price indexes. But it's very important to keep the long term in mind, and the Fed is not going to move until they see inflation over 2% for numerous months in a row, and they have to be concerned that it's going to continue going higher. Now, the reason I highlight all that as a starting point, when you think about your allocations to fixed income, interest rates are already at negative real rates. So if you take the nominal treasury yield of a US 10-year bond and subtract inflation from that number, you're at negative real returns. Now, what I've shown you here is if you look around the world, Australia out of the developed markets has the highest yields at about 1.4% on a 10-year bond. The US, 1.25%, 1.3%. Canada, 1.1%. You go to Europe, you're still at minus 40 basis points in Germany. Now, if you're buying a 10-year bond and inflation goes up 100 basis points, 1 percentage point, and if interest rates go up 1 percentage point, you're going to lose about 9% on a US bond, on a US 10-year. So again, if you own a US 10-year bond and interest rates go up 100 basis points, the value of your bond will go down about 9%. So that's about 8 years of interest income. So I think as investors, if we think about developed market sovereign debt, developed market government debt, we need to be really careful about how far out the maturity curve we go. Yes, I know it's tempting when a 5-year treasury yields 55 basis points and a 10-year yields 1.3%. Geez, you're getting like 2.5 times the income, but you're also taking a lot more risk in terms of the mark to market on your treasury. So my recommendation would be to think about other instruments that can give you interest income outside of government debt. So this could be investment grade corporate debt. It could be the higher rungs of high yield. I personally don't think it's a good idea to go deep down into distressed credit territory, but I do think you can actually get corporate credit, securitized credit, meaning mortgage-backed securities might be a better alternative. There are a range of ways to pick up extra income, and I should say, last but not least, emerging market debt might be a good alternative because there are quite a few emerging market countries that are investment-grade issuers who have debt issued in dollars and in their own currency where you can have a material pickup in yield. So on the corporate side, what you can see here is I've shown you in red the yield on a BAA Moody's corporate bond index. So this is the lowest rung of investment grade. You're still getting over a 3% yield there. And typically these bonds are going to be 5 to 7 years maturity, not 10 years. If we look at emerging market debt, what I've shown you in red is hard currency, meaning currency in US dollars, where you're not taking currency risk. You can get over a 4% yield, like 4.25% yield on that hard currency debt. And in a local currency debt, closer to 4%. Interestingly, historically, you can see the black line, which is local currency, typically paid a higher interest rate than dollar-denominated debt. because historically people did not want to take the currency risk. They would rather be owed money in dollars. What's changed now is there is a consensus view that the US dollar is in a weakening pattern, and you might want your money in other currencies other than US dollars. My personal view is the dollar is unlikely to weaken as much as people expect, so this might be a case where buying the hard currency is a better place to go. Along those lines, you can see part of the reason for my logic is the dollar is already down 10% from from a year ago levels. Now, I do think on the margin the dollar could decline, and part of the reason for that view, by the way, part of the reason why there's a consensus the dollar will decline is this premise that higher inflation in the US than in Europe means the dollar should devalue relative to the euro. There's another part to that story. That's the basic fundamental theory of economics, is that higher inflation rates or inflation differentials make all the difference, and interest rate differentials make all the difference. I believe there's another element here, though, that if the US is growing faster than any other developed economy in the world, people outside the US are going to want their money in the US, and they're going to buy US dollar denominated assets. And I think that actually could be an offset to some of this inflation fear, especially if you see that infrastructure investment I'm hoping we get in the next 1 to 2 years. What about equities? Well, equities have been an amazing space. I mean, obviously we've had a tremendous rally. If I look since the beginning of 2016, we've had the US equity market up a significant amount across the entire market, but this divergence between growth stocks and value stocks has been at a record level. Since January of 2016, the Russell 1000 Growth Index is up 173% versus the Russell 1000 Value Index, which is up 69%. So you've had a 100 percentage point benefit from being in the growth versus the value. What's interesting is since September 1st, and I'm not sure what's magical about September 1st, I can tell you, by the way, that was when Tesla and Apple hit what at the time was their all-time high. That's when retail was trading call options on those stocks like never before. We saw an incredible amount of froth in tech. Since that point, value stocks have actually outperformed growth stocks by 800 basis points. Now, again, I don't know what was magical about September 1st, but what I can tell you is the reason we've seen this rotation is partly because people have started to bet more on a strong cyclical rally. As we got good news on vaccines, people said, wait a minute, maybe now's the time to buy that airline stock or that hotel stock or these other stocks like banks. They've been really beaten down by depressed consumer demand, low interest rates, and a flat yield curve. Now, I don't believe the story in equities is as simple as sell growth, buy value. I also think you do not need growth stocks to tank for value stocks to work. One last comment, I think there's also a little bit of a false choice between growth and value. I would personally argue that Google is a very attractively valued growth stock. So is it growth or value? What I think is important here is you look at what's going on in the US economy. If I'm right, and inflation expectations are going to go up, that likely means yield curves will steepen. If yield curves steepen and long-term interest rates go up, that means the discount rate investors apply to cash flows far into the future are higher. If your discount rate's higher, you pay less for cash flow in 10 years than you do in 5 years. It's just a simple, basic net present value kind of equation. Well, the challenge here is some of the growth stocks that have done best are companies who don't have any profit at all right now, where there's more of a business plan than an actual business. Now, I think those companies are at risk in a period of steepening yield curves and higher discount rates. The growth companies that actually are growing and generate a lot of cash flow now, I don't think are really at a lot of risk. I think those can still be good stocks. So I would argue that where you want to be invested going forward is in some combination of high quality companies with high returns now that can be sustained or even grown in the future, as well as some of those cyclical recovery stories, some of the companies that have been beaten down by this yield curve shape, by the level of interest rates, traditional value stocks that are more industrial, cyclical, and in particular, I would say some of the financial sector like the banks. So I do think this is a case where if I'm right, we might be at a very important inflection point where we see this growth value trajectory change, not only in the US, but outside the US, where we saw similar dynamics, although less extreme than what we saw in the US. So I'm going to wrap it up over the next couple of slides and have some Q&A. I apologize, I've gone on longer than I wanted. So what is the backdrop for my asset allocation kind of investment recommendations? Well, number one, on monetary policy, a core premise here is that whether the Fed calls it yield curve control or whether the ECB calls it yield curve control or not is not important. I think what they're doing is trying to basically contain interest rates at very low levels to stimulate growth. And what the ECB and the Fed desperately want is inflation expectations and true inflation to move not only to their targets, but in the case of the Fed, above their target. If that's the case, short-term rates are going to stay at zero for the next several years, in my view. Now, that means you could see, as inflation expectations go up, that yield curve steepening I talked about, which means it's going to be very important to manage your duration of your fixed income assets. Now, second part of this, on fiscal policy, I do believe in the US we are going to continue to see incremental fiscal relief or COVID relief from the Biden administration, whether it's with just Democrats or whether some Republicans come along for the vote. Doesn't really matter to me. All I care about is how much COVID relief we see and how much that stimulates growth. And I think that will be a game changer in terms of finally using fiscal policy, unlike what we did in 08-09, to stimulate the recovery. Very importantly, if we augment that with infrastructure investment that raises long-term productivity growth. And again, if I were advising Biden, I would say go big, go for $5 trillion. Don't go for $1 or $2 trillion because this country needs tremendous investment. That can raise the long-term growth profile of the economy. That can make investors think this is different. We're no longer in that debate about secular stagnation. And it could change how people think about inflation well beyond the near-term recovery. Now, if all that's true as it relates to your fixed income assets, I've covered parts of this before, I do think you will continue to see a gradual yield curve steepening. I think we're going to see the US 10-year yield at 1.5% to 2% in the next year. I think the Fed is going to get distinctly uncomfortable, I should note, if you start getting well above 2%. But moving to 2% on its own is enough to cause some of the things I already talked about in the equity market. It's also enough to cause real losses on long duration bonds like 10 and 30-year bonds. So I think developed market sovereign debt is increasingly unattractive in this environment. And it's probably preferable to look for spread products, as I mentioned before, like securitized credit, which would be mortgage-backed securities, asset-backed securities, investment-grade corporates, and emerging market debt. In the equity market, a stronger, broader economic recovery means you're going to have more companies to choose from who have revenue and earnings growth. It means you won't be relying on 5 or 10 tech stocks to drag the entire S&P 500 up like we saw for much of the last few years. But it also means higher discount rates. So if you're more of a business plan than a real business, there's an air pocket under your valuation. And so I think valuations do matter. Current returns on capital and the sustainability of those returns on capital matter. And I think you're going to see an equity rotation that continues where those growth indices no longer look so much better than the value indices, and quality and cash flow are what people should focus on. I should note, I think sustainable equity investing is going to be increasingly prominent in the United States. The US has actually been left behind by most of the rest of the world on ESG, environmental, social, and governance topics. When we compete for investment opportunities out of Europe, Australia, Japan, Canada, if you're not a strong environmental, social governance investor, you're not even considered. And what do we mean by that? This is not applying some kind of moral or value lens. What investors outside the US are saying is the business model sustainable? If social media companies are leaking your privacy data and are not protecting it, that business model might not be sustainable. If a financial institution has instances where they're basically violating your trust and creating fake accounts for you, is that sustainable? So they're really trying to price in these kind of less quantitative factors and also trying to consider irrefutable issues around climate change and saying, what will that mean to the business model if governments actually address these challenges? And I think that's something where investors in the US would be behooved to really focus on sustainability and thinking about business models in that regard, always going back to what do these considerations mean for profitability and the value of the company in the long run. And last but not least, on alternative investments, I do think in an environment where the yield curve is steepening, where the equity market is broadening, there might be some new interesting opportunities to consider beyond just private equity and hedge funds. We've seen record issuance of SPACs in the last 14 months. That's creating an opportunity in an instrument called PIPEs, Private Investments in Public Equity. I could talk about that more in Q&A if you're interested. I do think you're going to see income producing real estate be a really interesting opportunity coming out of this pandemic, as the pandemic has completely disrupted center city office properties. It's disrupted rental apartments in major cities that were high cost cities. So I think there are going to be areas there where you can seek inflation protection and income, and those are worth doing some extra work on as well. So again, in summary, the backdrop here for the economy is probably the brightest it's been in decades, presuming we get this vaccine rollout at the pace I expect. I think it will be a global recovery, but the US might be at the forefront for the next couple of years. And it's going to create some really interesting volatility and change in investment markets that I'm sure our friends at Pinnacle will be happy to help you with. And I'm happy to answer any questions I can in the Q&A now.
Ron, you're really great. You certainly don't need to apologize at all for providing us additional information. We do have a couple of questions that have come in here. Before I get to those, I would just remind everybody, if you do have a question for Ron, just please use the Q&A function. You can type your question in. We'll take a look at it. We'll try to walk through those with him as we go through here. Ron, one of the first questions we had, sort of your overarching backbone to what you talked about with the recovery here is with respect to COVID. And what is your opinion if the mutated virus, specifically the UK variant, reaches a level of 25% infection here in the United States? What do you see the impact there?
Yeah, so thanks for the tough question right out of the gate. So no, I think that's why I described it before as a race, because the more people we can vaccinate in the US, the less likely it is that UK variant or the South African variant can spread widely, right? So this is, and by the way, I should also note, keep in mind, I'm talking vaccinations. About a month ago, the CDC put out an estimate that they thought maybe as many as 50 million Americans have actually already been infected with COVID. So the number of people who've tested positive is way below that, but a lot of people who had it never got the test, right? Or it was never identified, we didn't have testing capacity. So keep in mind, this is a race between the number of people who've already been infected and have antibodies, which our current knowledge seems to say the antibodies last around 9 months at minimum, plus the people getting vaccinated. So I'm kind of trying to dodge your question of how it happens, because I think we actually have a shot of beating that probability. I don't know if 25% is a magical tipping point. I mean, again, keep in mind the other point I tried to make earlier is even if these new variants are not, or even if they're less susceptible to the vaccine, what we have found so far with the vaccines from Pfizer and Moderna anyway, is that they're still extremely effective at eliminating the risk of death and hospitalization. So again, even if you get to 25% or some other number with the UK variant, I think what we're seeing now is that the risk of death is going down precipitously, which is a great outcome. I think it's tremendous in terms of being able to open the economy. Sorry if I'm using hyperbole. So I think that's the real case is if you haven't signed up for your vaccine, get one as soon as you can. And if you know anyone who is eligible and hasn't signed up, get them to do it as soon as they can.
That's the message, I guess, is to go get vaccinated, right?
That's our PSA for the day. Sorry.
That's right.
So, good.
Another follow-up question. So question comes in, Biden has campaigned on raising taxes on individuals making $400,000 and above. During your discussion, you were talking about raising taxes on individuals or families earning $1 million and above. So do you anticipate some sort of compromise? And when do you anticipate all this legislation potentially being passed?
Yeah, so here's the core premise of my bet. I mean, let's be honest. The Democrats barely squeaked their way through to having a majority with Kamala Harris as the tiebreaker. So if we think about the elections, Georgia obviously was a surprise. It was kind of a fantasy win for the Democrats in terms of winning both of those seats. But keep in mind that basically what you've got is in 2022, Warnock is up for re-election. He's filling out the last 2 years of another Senate term. If you're Senator Warnock, do you really want to campaign again in Georgia, which in my view is still a red state? Maybe it's tinging purple. It is not a blue state. Do you really want to go campaign for your re-election in 2 years when you haven't established yourself well enough to have all those powers of incumbency on the back of a big tax increase? And if you're Kirsten Sinema and Mark Kelly in Arizona, which is a purple state at best, do you really want to campaign on having passed a big tax increase? I don't think so. And so kind of my bet is that everyone talks about Joe Manchin from West Virginia because he votes Republicans more than any other Democrat. By the way, West Virginia has the fewest people in the country probably who would be affected by a tax on over $400,000 a year. But, I think there are enough Democrats who are not going to want to run for re-election on the back of a tax increase that it's going to be very tough to get those increases through. Now, if it's people who make over $1 million a year, I think you can get those Democrats to vote for it. 400,000, if I really quantify that, I think about Married filing jointly, I think you're talking about 1.5% to 2% of the population earns over $400,000 a year. Again, in the world of finance, that doesn't seem like an extraordinary number, but this is really out in the tail of income distribution. Statistically, maybe they would be comfortable with that, but I don't think they're going to want to campaign on that. So what I'm betting on here is I think you get a corporate tax increase from 21 to 28%, which, by the way, importantly, I didn't touch on this in the slides, is a 7 to 10% hit to S&P earnings. So that is important. I think you get an increase in personal rates, perhaps for people making over $1 million a year. In particular, the one that I would watch for people who are high net worth, high income, is Biden has proposed eliminating the preferential treatment of dividend and capital gains for people who make over $1 million a year. Now, this is effectively a wealth tax in a different form. It's a wealth tax you can actually execute because we all file our taxes every year. And if you make over $1 million a year, you're filing how much dividend income you had and how much cap gains income you had. And the reason I say it's a wealth tax, there were 514,800 filings in 2018 that made over $1 million in the US. That's out of 145 million filings. Shockingly, 94,000 of those filings, so basically almost 20%, had zero wages or salaries. So I think what the Democrats are targeting here is the heir to pick whatever multinational company, someone who's the great-great-grandchild of a company who's never worked a day in their life and is actually living on millions of dollars a year of dividend income. They're trying to find a way to tax that as if it was ordinary income and get that revenue. So I think that one is something they might be able to get through. But I think beyond that, it's going to be tough to see any major tax plan get through this Congress. And again, one last thing, keep in mind the Democrats' majority in the House is only about 10 seats too. So it's not like Nancy Pelosi can lasso all these guys and say, we're rodeo, it's time to raise taxes. I think this is going to be a tougher lift than people think. Sorry, last thing. Where you will see it go through is they're going to probably try to put it through as part of the infrastructure program to fund part of the infrastructure. And in that way, say they're investing for the future by making people pay their fair share. But again, even there, I think it's going to be tough.
Thanks for that insight. Ron, we've had several people that have chimed in asking for you to elaborate on your PIPES alternative investment. So would you elaborate for that? Just describe that for us a little bit more in depth.
Oh, I wish we had another hour. So let me just leave you with a teaser, and we can always follow up with more information.
Maybe we'll have part 2 of this.
I'd be happy to do it. We've now had $130 billion of SPAC IPOs since the beginning of January last year. There are over 300 SPACs looking for deals. I would in no way, shape, or form say this is sustainable. I do think, so the level is not sustainable. In fact, by the way, 83 billion of originations last year, over 47 billion in the first 6 weeks of this year. So the current 6 weeks are more than in like the last 20 years before that combined. Having said that, I don't think you can continue to have so many SPACs, but I do think SPACs are a sustainable way for companies to go public as an alternative to an IPO. I would describe it as a structured IPO. And we can dig into it more if you'd like. But the key point here is I think SPACs are around to stay, maybe not these volumes, but most SPACs, to do an acquisition, they typically need capital beyond what they raised in their IPO. So let's say you're a SPAC that raised $250 million in your IPO, and you find a $2 billion company you want to take public. Now, you might recall in typical IPOs, the company doesn't sell every share to the public. They typically sell, let's say, 20, 25% of their shares. Let's say in this case, the company wants to sell 25% of their shares. So $2 billion company, 25% is 500 million. Unfortunately, if the SPAC only raised 250 million, how do they pay for the other 250? They issue a PIPE. So there's a massive amount of SPAC capital that's been raised, but there are no dedicated PIPE funding sources. There aren't dedicated PIPE funds in the market at this point, but we think there's a real opportunity there, and it's something we've worked on. There are some hedge funds trying to figure out how to do this, but there is a lot more complexity to the topic. But I think this is a way, I think what's interesting here is going forward, I think you're going to see more companies go public via SPACs than we've seen at any point in the time in history. And the reason you're seeing that is the cost differential of going public via SPAC has gotten closer and closer to that of an IPO over time. And there are other benefits you get from going public this way. So ignore the hype around celebrities and athletes raising SPACs. I don't think you want to just buy SPACs, by the way. I think some of them you should probably avoid. You wouldn't even use your neighbor's money on. But I think there is an opportunity in this space.
Lisa has a question, just your overall opinion on traditional brick and mortar type retail businesses and
Yeah.
what you see as the recovery for them as we walk through this year and into next.
Yeah, that's a really hard one. So I guess point number one would be the US has more than twice as much retail square footage per capita than any other developed economy in the world, I believe. We are massively over retailed, and that was before the pandemic, right? Number two, during the pandemic, even my parents learned that shopping online is actually pretty easy, right? So I mean, you get older generations of people who were not really comfortable buying everything online, who would rather go to the Sam's Club or the Costco. You've seen a whole new group or cohort of people get very comfortable shopping online and might not go back to bricks and mortar. So I guess, when I look at bricks and mortar, I think you've basically had what was already a pretty challenging situation for many of these retailers just got even worse. I mean, some of them seemed like they were near the brink during the pandemic. Maybe they're getting a reprieve, and maybe in 2021, on the back of my kind of optimism around the economy, they'll get another reprieve. But I think the structural story is still pretty negative unless you have a very differentiated value proposition as a brick and mortar retailer. And frankly, by the way, I do think one thing that we're seeing is kind of a convergence between brick and mortar and clicks, where you're not just bricks and mortar and you're not just clicks, you're actually both, right? If you think about what Amazon's doing in terms of more and more kind of fulfillment centers that are closer and closer to the customer, what you've seen with Walmart and buying jet.com and really kind of becoming multi-channel, I think the winning model is going to be doing all of it. But if you're just bricks and mortar, it's a pretty tough situation out there unless you are really unique, offering something that your competitors just can't do, or offering a kind of cost proposition your competitors can't match. So, broad statements, I think it's a really tough space. I mean, that's where I think your security selection is really going to be important, and having the right kind of asset manager choosing where you want to play or where you want to invest is very critical. But generally, I would say I'm not looking at it with a very positive lens.
I think that's helpful. So I think the last question we'll address today is from Mike. And Mike's just curious, Ron, on your perspective on what's too much debt, particularly compared to GDP, and at what point do we consider how much is too much debt?
Yeah, so this is the toughest thing. I mean, post the financial crisis, for the last 7 or 8 years, I basically told people that I thought we were going to see in the next serious recession central banks funding the deficits. And that's basically what we've seen. The ECB, the Bank of England, the Bank of Japan, the Federal Reserve, no one's saying it. But if you look at how many bonds, government bonds, the Bank of England has been buying, it just happens to match the size of the deficit on a regular basis in the UK. And so, one thing that I think we've been able to do, which you can't do forever, is we've actually had central banks funding deficits. Now, historically, that would have been a recipe for hyperinflation. But I think what the markets have realized is that this is something that is sustainable for a defined period of time, but we need to have confidence that it won't go on forever. So I think that's an important point to make for the short term, that this is just part of monetary policy operating independently, but coincidentally being where the federal government needs it to be. The hard part is, you might recall in 2009, Ken Rogoff and Carmen Reinhart, who were both at Harvard at the time, published a book called This Time is Different, where they assessed what level of debt to GDP a country could sustain without impairing their long-term growth rate. And they came up with a number, I think it was 60%. Well, pretty much every developed economy other than Germany is above 60%. In some cases, at double 60% in the case of Italy. And it's not clear that that number is really the only number you should look at. What you really also have to look at is, what is the debt servicing burden? What percentage of GDP are you spending on interest expense? And what we're seeing right now is the US government has more debt than it's ever had by a long shot. And yet interest expense as a percentage of GDP hasn't gone up. So the real challenge is going to be, is if I'm right, inflation expectations go up and yield curve starts to steepen and those interest rates start to go up, what does that do to growth, and what does that do to tax rates? Right now, my core belief is the key job is to get the economy out of the rut. I mean, put it a different way. There's this giant demand chasm between the pre-pandemic and the post-pandemic world. We got to build a bridge and get across that bridge. Once you're across that bridge, I think we need to shut off all of the extra spending, right, that we can. We shouldn't be handing out extra unemployment benefits. We shouldn't be sending checks to households. Once you're across that chasm, you move back to business as usual. The goal is get the economy on its feet and then let it run on its own. But that's why I keep emphasizing infrastructure. What you really want to do is help the economy run faster at that point by making it more productive and getting rid of any other excessive spending or superfluous spending. So I guess this is a long way to say there is a limit to debt to GDP. I don't know what the U.S. has been fortunate to have the reserve currency of the world. We should not assume that will last forever. Part of why we've had that is rule of law, independent, strong institutions. But for now, the key goal is get across that chasm, get to the other side, and then recognize that we were able to kind of get away with funding this with massive deficits, but that cannot be our new MO or modus operandi. We have to get back to fiscal discipline, and that is going to probably mean some meaningful spending cuts and also higher taxes in the long term, because there's no way to bridge the gap beyond those kind of two tools. Sorry, that was the ultimate long non-answer, but it's not where we are. It's higher than where we are, but I don't know how high it is. But we're going to have to be really careful and disciplined is kind of the short answer.
Well, it's certainly a challenging question that I know we'll probably continue to talk about for weeks and months and years to come. Ron, I'm thankful for your time today. Thanks to Keith Davis and the Pinnacle Trust and Investment Services team for extending the invitation and putting this webinar together. We hope it's been helpful to everybody who's participated with us today. We would remind you that it will be available through our YouTube site. If you go to youtube.com/watchpnfp, this webinar will be available to you soon. Ron, thanks so much for the time today. We wish you well, and hopefully we'll get to have you back with us to offer some more insight for us.
Thank you. It was a pleasure to be here. Stay safe in snowy Nashville.
So much, Ron. Take care.
Thanks, everyone. Bye-bye.
Y'all have a great day.